Let's talk market fundamentals with Mr. U.R. Bhatt, Managing Director of Dalton Capital Advisors. Mr. Bhatt, morning. Good to have you back. Mr. Bhatt, are you personally surprised with the speed of the rally? In quick time, Indian markets have gained more than 5% from the recent lows.
Well, indeed, I think there's a case to be surprised about the momentum that the market is still displaying, based on the ground reality in India, whether it is in terms of corporate earnings, whether it is in terms of changes in the economic firmament, or even the political climate in the country. So therefore, that is as far as India is concerned, plus also the fact that the momentum of FI inflows also has sort of slackened a bit. If you see the $12 billion that has come into India from January this year, the bulk of it has come in the first 2 months. And after that, it has been sort of slowing down a bit. So, but despite that, the market has done. But, you know, as a matter of fact, even this 12 billion has really taken the market up only by about under 3%. Whereas, if you see last year, double this money, about say $23–24 billion, caused a rise of something like about 23–24% in dollar terms. So therefore, there is a fact. The fact is that there is more money that is required to take up the market. So there is an element of doubt, as it were, in the market. So it all go. I mean, the final call is how much more will FIIs pump in money so that the market can keep going up, because the local circumstances do not seem to warrant such a great optimism in the market.
I completely agree with you, Mr. Bhatt, but do you think in such a market, the right thing is really to focus on global liquidity and the global mood? We can endlessly talk about political problems, earnings, inflation, private sector capex not starting, but none of those arguments have made money.
Well, yeah, that's a fact. I mean, if you were short on the market based on these factors, of course, you lost your shirt. But the point is that finally we have to take a call as to how foreigners will start looking at India. But one point that is worth noting here is that immediately after the budget, the market took a rather steep correction, and that is when the government of India went abroad and said that we're going to fix all the problems, whether it is in economics, whether it is in stalled projects, all that we're going to fix, whether it is in pricing of diesel. So, but I think except for pricing in diesel, where some baby steps have been taken, on the other areas, probably we have still not delivered. So therefore, there's a time up to which foreigners are going to really keep giving you time, further time, to address the problems that are there in India. So, I mean, as long as liquidity continues to be very, very robust, there would still be some money coming into India. But as I said, the increasing amounts of money are required to convince foreigners or to take the market up, because basically domestic investors have been very big sellers for the last several months now. So I think the space to watch is how flows sort of play out in the international markets, for which we really have to keep track of what's happening internationally in terms of liquidity, whether the monetary easing program is going to continue, is going to become more robust, or probably there is some sort of reversal of that monetary easing on the horizon sometime in the future.
Fair enough. Mr. Bhatt, however, what's characteristic of this rally is the fact that, we've seen only defensives move up so far. The leadership for this move has come in from defensives, whereas traditionally what we see is on a risk-on rally, the rate sensitives and cyclicals also start moving up. You think it's about time that happened?
Well, of course, if there is further inflow of money of a much larger magnitude, that could happen. But this only shows that all the money that is really coming in is not terribly convinced that there is a great turnaround happening in India. So therefore, let's back the cyclicals. That is not the case. Even the investors who are coming into India are somewhat cautious. That's why they are onto the defensives, despite the fact that the government has been making the right noises internationally, saying that they'll fix all the problems. So therefore, I think there is quite a lot of caution that foreigners are also expressing in terms of their action by backing defensives, even though money has been coming in, but it is not really going to the sectors where on a delta basis there will be a lot of money that could be made if the right decisions are taken by the government.
Do you think it's time to be constructive on OMCs as a group?
But certainly, I think nobody expected 1 year ago that diesel prices would start inching the way up as it has happened. So I think there is certainly a fundamental change taking place there. The fact, of course, is that they have phenomenal assets on the ground, so therefore they're certainly worth much more than what the market prices seem to suggest. But the only problem was about pricing, and if pricing is going to be somewhat nearer sort of free market pricing, then I think there is huge value there. But taking a call that everything will be fine in the run-up to the election for the next few months or next 1 year is probably a bit more sanguine than what experience suggests that we should be doing. So I think there will certainly be some hiccups on the way, but I think things have changed fundamentally. There is certainly a case for being constructive on these stocks, but I think we should watch the space very closely, because in the run-up to the election, like you saw in the run-up to the Karnataka election, even that monthly rise got stopped. So I think in the run-up to the national elections, you don't know when this will stop, and things will go back to the good old ways. So therefore, I think one needs to watch the space, but there is certainly some dramatic change there.
Right. In terms of purely the rate sensitives and the moves that we've seen, the differential trade between PSU banks as well as private banks, do you think the tide is changing for PSU banks with the kind of numbers PNB reported?
Not really. I think if you really see the new normal for net NPAs for most of these public sector banks is about 2%, which is more than double what it was just about 12-18 months ago. So I think there is certainly a lot of stress on the balance sheet as far as public sector banks are concerned, and we really have not seen the impact of stressed assets on restructuring, because quite a lot of these projects, whether it is on the road side or on the power side, these have really not been commissioned, so therefore they are not still classified as stressed assets. But I think maybe a couple of quarters from now, if nothing really happens on that front, I think they will need to be classified as, they will need to be restructured once more, which sort of ensures that the stress assets would probably go up. So I think we have not seen the worst as far as public sector banks are concerned. So that's why they're quoting at sort of valuations which are dramatically lower than the private sector banks, who in turn have been able to manage the slowdown in the economy quite well as far as their stressed assets are concerned. So I think the worst has not been seen. There is still probably a quarter or two for us to wait out before we pass judgment on the public sector banks.
Come in on the media space, because with digitization there's much talk about how the distribution companies get benefited, how there's more declaration of viewership. Do you think the digitization is going to hit as a wave hit the media counters?
Well, there's a lot of hope on that front, thanks to the changes in the environment there. But anything in India doesn't happen in a great hurry. So therefore, I think it will take quite some time for really the changes to show up in numbers as far as these companies are concerned, because most of these companies are either marginally profitable or loss-making, and it is not as if they will turn around dramatically just over the next couple of quarters. So I think this is a long-drawn story, worth backing if you are a real long-term investor, but for others, I don't think there is too much steam immediately, at least.
Mr. Bhatt, you are sounding really either bearish or cautious to me. At a time when globally the uptrend is so strong, does it pay to be so cautious? Because best part of the rally maybe could be behind us by the time you'll turn bullish.
Well, we are close to historic highs as far as the Indian market is concerned. Of course, even internationally, there are several markets which are at lifetime highs. But the fact is, at least there you have a lot of monetary easing, which is really, and there is some perceptible improvement in say, for example, the employment scene as far as the US is concerned. All these monetary easing has certainly helped the equity markets there. Whereas in India, we are really dependent on, we are a sort of single trick pony. We need FII money to come in to ensure that markets are kept up, because the local factors don't seem to be supporting this very much, unlike elsewhere. Like, say, for example, if you see the economy, all the problems that we had, say, 6 months or 1 year ago are still there. There are not too many sort of factors that seem to have changed dramatically there. On corporate earnings, it doesn't look like as if there is a huge groundswell of opinion that we need to invest.
I take your point completely, but there's an old maxim on Wall Street, which is bull markets, they always climb wall of worries, don't they?
Well, yes, that maxim is there, and for the market to really hit the all-time high and overtake that, there has to be a lot more of groundswell of support from all kinds of investors, including domestic investors. Because if you see, the domestic institutions have been big sellers for the best part of the last 2 years, and they continue to be big sellers. So therefore, it is not as if one section of the market will continue to be terribly bearish, and it's only FII money that can keep taking the market up. I think on the ground, some perceptible change needs to be seen in terms of sentiment, in terms of entrepreneurs being convinced that there is further investment called for, there is a case for further investment. All these things need to happen for this market to really sustain above the all-time highs. And it has to have some element of euphoria for that earlier high to be cleared. We are not seeing that immediately, but things can change over the next 1 quarter. There could be certainly some amount of dramatic change that can happen in the economic firmament, thanks to political probably changes, or thanks to decisive action by the government. So that is certainly a possibility, but that is not something that we would discount in a great hurry. So therefore, I think crossing the previous high is not so very easy in India, given the local conditions. But if it is only sort of contingent on further FII money coming in of a dramatically higher magnitude, that is a risk that you have to take if you want to be cautious.
Why has the Indian pharma space got re-rated? If I look at the large quality pharma names, all of them either are marching towards the new high or are sitting at a new high. And let me give you some names here: Lupin, Dr. Reddy, Sun Pharma, and with the exception of Ranbaxy, A quality pharma, it's pretty much trading at the top of the heap.
Well, they have had reasonably good performance in over the last few quarters. Plus, also the fact is that, as I said, when investors are not really backing cyclicals, so they really need to buy into these stocks, which are not terribly expensive compared to their historic peaks. Plus, also the fact that they are coming out with reasonably good performance. So I think it is the flood of money that is coming in, which is seeking sort of safer revenues, and that is why you have seen companies in the pharma space and also the FMCG space. These are the spaces where, and the private sector banks, these are the spaces where most of the money seems to be headed. And that is why these have done very well over the last few months.
Really appreciate your time, and so glad you could accommodate this interview request.